you're going to make more money than what you're going to spend. And you're going to sleep well at night because you know you don't have to worry about your receivable being paid. It's just a simple matter of sleep well, get paid, grow your business, make more money. Sell it.
The Industrial Growth Institute podcast connects you with the big thinkers, makers, and subject matter experts across all aspects of an integrated B2B industrial revenue growth function. From strategy, board oversight and transactions, through all the phases of manufacturing marketing, the complexities of industrial sales, and the nuances of marketing and sales technology and customer experience, I speak with guests who bring insights, innovative perspectives, best practices, and twists on traditional approaches. Each episode explores high-level thinking and in-the-weeds actionable tactics. If you enjoyed these discussions, then please help me out by liking and sharing the podcast, and especially by leaving a comment and giving a review. So with no further ado, let's jump into this episode. Welcome to the Industrial Growth Institute podcast. In conversations here, we touch on a lot of different aspects of growth. Some are direct, like sales training or sales techniques, and some are much more oblique. The common thread, though, throughout all of these, as we weave them together, is that they're all part of an overall approach to growing revenue for industrial manufacturers. Today, we've got an interesting topic that fits into that in, I think, a unique kind of way. We're going to talk about trade credit insurance. I think that this is something that's overlooked by many companies, and it actually, not only does it mitigate risk, but it can create some interesting opportunities. Joining me for this conversation is Dan Schobel. Dan is a 17-year veteran in this industry, someone with a great deal of knowledge about the ins and outs. He's also a salesperson in his own right, who I've watched in action for about 15 years, who I think can teach us something about selling a product or service that buyers might see as nice to have. They might not necessarily understand why they ought to have it. Dan is the principal of TradeSmart LLC. That's a full-service trade credit protection product broker. He's been working in the receivables protection field for over 17 years. He's been with firms like Volofin and Cofast before launching his own company. His focus, as he describes it, is on helping companies better protect and collect their domestic and foreign receivables at the same time while decreasing the cost of financing, freeing up cash, and increasing sales flexibility. We're going to really dig into that sales flexibility piece of it as we talk. He's also a speaker on global political risk and receivables management. He speaks various places throughout New England, serves on the planning committee of World Trade Day at Bryant University. We may even yank his chain and get him to talk a little bit about tariffs today during this conversation. But early in his career, he was actually in government relations. So in addition to running his business, he's also a husband and a dad and a trailer glamper. We'll see maybe what his favorite spot is in New England to go to. It happens that in between scheduling this episode and recording it, Dan launched his own business. So the firm that we talked about, TradeSmart LLC, is a new entity that he's launched, and we're going to learn some about that decision as well. So lots to talk about. Be sure, as you watch, hit the bell, share, comment, subscribe, and please join me in welcoming Dan Schobel. Thanks for joining me, Dan.
Pleasure. Good to be here. Always fun talking to you, Ed.
Yeah, I enjoy it. So, bold move, launching your own business. Congratulations. What prompted that?
It's just a lot of things. I said it was ultimately it really came down to this. If I don't do it now, when am I going to do it?
Right.
5 more years, I'm going to say I'm ready to retire almost. So, not the time to do it. This is it or not. So.
But in many ways, you've been an independent contractor for the last 15 years or whatever. So this isn't entirely new, right?
No, not at all. I mean, when I was with Cofas, which that was my first 14 years in the industry, for a good part of it, I was considered an independent agent. And then even when they brought me kind of in-house as more of an employee type situation, I worked from home. I was, pretty much independent. So it's been almost the same throughout.
It's a little different now, though. I mean, we talked earlier about some of the challenges you're facing and wrestling with, like you're your own IT director now.
Yeah, that's quite the fun thing to know.
It's funny. That's one of the most common friction points that I encounter when I talk to people who are just launching their own business. Suddenly, they're dealing with email crap and all this kind of stuff that somebody just took care of for them before.
That's exactly what I'm going through. Like today, magically, suddenly I can't send emails for the rest of the day.
I'm sure many people listening have great empathy for you. Anyone who's wrestled with that knows how frustrating it is.
So, now I have a lot of empathy for what they went through.
Right. Absolutely.
Yeah.
All right. The key point that we're going to get into in this conversation is how I believe your products can help industrial manufacturers sell more. But before we get there, kind of help us understand who Dan is and what your perspective is. How did you get into this business originally?
I think most people in this business are going to say they're not really sure how they got into this business, but it was actually, my father was in credit for large multinational corporations for years. He knew folks at Kofas. He knew I was looking for kind of a career change. Made an introduction, and it happened. And here we are 17 years later. It's been an amazing ride. I have an absolute love for what I do, meeting different companies, doing all these really cool things throughout New England. It's every day is an adventure, you know?
Building a career in the insurance industry, I don't know the ins and outs of it. My sense is that compared to many of the industrial salespeople that I work with that have base salaries and relatively little pressure, I think you essentially have worked just on commission all along, right?
Yep. I started as 100% commission when I came right out the gate, and so that's why I'm opening this business. It's kind of the same thing. I've been doing it straight commission from day one. So
that certainly has to focus your sales effort, though. I mean, there's no plan B. You talk about eating what you kill.
Yeah, pretty much, 100% it. And that's why it's kind of one of these interesting situations with what I do. Is a lot of people in this business, they kind of go for what is a good premium, but maybe not the best premium because they're living the same way, hand to mouth. I look at it as a completely different thing. My job as your broker is to make sure you get the absolute best, even if it hurts my pocket a little bit. Because at the end of the day, I want you happy. And if you find out later that I could have gotten you better, well, that's not going to reflect very well on me. So,
but there's also a difference between the premium and the coverage. You got to make sure people have the right coverage, and in many cases, more coverage than they might have thought they needed.
Yeah, I mean, you definitely have to do a little bit of an education with folks. A lot of the times, they really don't even know who they're ultimately selling to. I've found many times they think they're selling to XYZ, but really their risk is the company 2 layers above them that's ultimately responsible for the bills. And if they say, we don't have any money to give you to pay the bills, your customer is going to say, sorry, our parent, which you didn't even know existed. So you don't. A lot of people don't really even know who their actual risk is,
right?
Which is an interesting thing. And coverage is definitely key. Structure is key. There's something in some industries called dating, where you sell to people in January, February, you ship them immediately or as the product comes in, and you don't actually the invoice doesn't become due until December.
Wow.
So you've got a 11 and a half month window before it becomes available. That's one, it's a huge risk. And two, a lot of people don't know how to get that covered properly. And if you don't have it covered and you have a claim, they're going to say, well, you were outside the terms of the policy. So you got to make sure your broker knows exactly what they're doing.
All right. So we're going to dig into some more of those details. I want to pull a little bit more on this thread of how you sell. I know at one point we spoke probably a year ago, and you were experimenting with a lot of very high intensity, high volume prospecting using databases and sequences and cold outreach, almost like a software BDR. What have you learned at this point in your career? What % of your time do you normally spend prospecting?
I could almost say 100%.
Right.
I mean, if you're in sales, you're always prospecting. So it never really stops. Even when I'm talking to current clients,
right.
I still consider them, a potential lead source. So, now I'm not selling them. I'm just talking to them and
Sure.
working with them to get them what they want. But, so I think I'm always kind of prospecting. There's some really cool stuff out there right now that I think any sales guy in any industry can avail themselves of, that really streamlines the effort and can get your message out there in bulk very fast, and your return rate isn't going to be 10, 15, 20%. But if it takes you 10 minutes to prospect to 1,000 people and you get 4 or 5 back, well, that was 10 minutes where you got 5 solid leads because they got back to you because they saw your message.
So I think there's
to talk to people about on the sideline, but because I obviously don't work for those companies.
There's a lot of philosophical debate. I mean, this is an important sales topic, whether that kind of prospecting is spam or if it's prospecting.
I'm going to say it's prospecting. If you don't want it, you can delete it. You can say, hey, can you take me off the list?
Right.
If you keep sending it, then it's probably falling into the spam category. But a lot of times I might get people say, I'm not interested in this, but thanks for your email. Gave me a heads up on something to keep my eye on. I try not to send these things out to the same people multiple times in a month. Usually it's like once a month, once every other month.
Got it.
So I'm not inundating people. And I think that's key.
Yeah, for sure. So being in the trenches, you're listening to people talking about their own sales. You've got this insight. You're always selling. You're always prospecting. How would you describe the state of sales today in the B2B space, and how has that changed over the last 10 years?
I think it's definitely. I think it's a lot more competitive because there are a lot of different resources that people can use. Whereas before it was knocking on doors, sending mailings, and that's pretty much all you had. Now there's so many ways to get in touch with people and to narrow it down to the decision maker that you need to talk to.
Right.
That everybody can get in to see the same guy. So there's a lot of noise, I guess you could call it.
In your business, the decision maker is the owner or the CFO or who?
Usually owner, CFO, possibly controller.
So you've got to be sharp enough at your game to be able to get to the C-suite, get to the owner.
You have to know what you're talking about.
Right.
Because trade credit insurance is a very specialized product. It's if you don't know what you're talking about, they're going to figure it out really quick.
What I hear from a lot of salespeople, though, is that it's impractical. There's no way that a salesperson can get to a CEO or an owner, and I think that's baloney. And what you're demonstrating that you can.
That's really all I deal with.
Right.
They may send my email or send a message to somebody underneath them, say, hey, reach out to this guy, and start a conversation. But you can get to them. You got to use the right tools. And that's, again, I'd be happy to to discuss that with anybody after this discussion.
All right. Yeah. I'll include your LinkedIn profile and some other contact details in the show notes. So that's a generous offer for you to make. All right. Let's talk about trade credit insurance. Define for us, what does that mean?
It is a protection against customer default, bankruptcy, and slow pay. So if a customer, go ahead, Ed. Sorry.
So essentially receivables insurance?
It's receivables insurance. Yep.
Okay.
It's not a factoring tool. There's no financial back and forth. It's strictly protection. A lot of people confuse it with factoring. It is not factoring, and it is a fraction of the cost of factoring. I mean, we're talking less than 0.25% of sales. So,
and experience tells me that factoring has this negative connotation that only if a company is really on the edge and they're desperate for cash would they use factoring, which is essentially a way to pull forward their receivables as opposed to mitigating the risk of default on receivables. It feels like it's a very different sort of a product.
It is. I mean, there are certain industries where factoring is just, that's what they do. Okay. Everybody does it. If you don't do it, people are a little confused why you're not. And those are ones where you have to do a large purchase. So typically you're using a purchase order finance, and then you're going to parlay that into a factor where the factor pays out the purchase order finance guy once the shipment's been made. And so these are people that have to order now for an August delivery for the fall season.
Got it.
And the opposite, they're ordering in July for the spring season. So they've got such a long stretch
Sure.
that they need that to help bridge the gap.
All right. Most of the people listening to this in the industrial manufacturing space are either professional services for manufacturers or kind of consumable products or capital equipment. So that probably doesn't apply. What does this insurance normally cover?
This covers virtually, it's exactly what it says. It's bankruptcy or slow pay. If the customer is slow paying because either they're in a financial difficult position, or let's say they're not going to order from you again for 7 months, so they're just going to drag things out because they know they don't need to pay you until they need to get product, you can file the claim or threaten to file the claim. Oftentimes, just the threat of the claim will get them to pay you.
What's the skin off their back? I mean, why does threatening the claim prompt payment?
Well, if you have, let's say you have coverage on XYZ company,
right? You
got to assume others have coverage on XYZ company, and if you file a claim, odds are they're going to get a cancel. Their other suppliers are going to get canceled. Their coverage is going to be canceled. It's in, let's say, seafood, which is a large user of this. All those guys have trade credit insurance, and if a guy gets canceled, he knows all his suppliers are going to call him and say, "What's going on? You're not paying people, and they're not going to ship them."
I see.
So,
all right. What if somebody ships a machine? So, in other words, it's customer property. The terms of the deal were that once it's shipped, it was the customer's property. If it's destroyed in shipment, and the customer says, "Hey, I don't want to pay the balance because I don't have anything that's usable," would that pay out?
That does not. That would be something that you would have to insure through a P&C type situation. Your logistics company would probably be the best person to start with that because that's where they specialize. But you would have to cover the shipment. It's similar to like if a container falls off a ship in the middle of the ocean.
So there are certain situations in which non-payment is not covered.
Non-payment would not be covered in the event where there's a dispute. They say that the product you sent was no good.
Okay.
So in the case of this equipment that was destroyed in shipment, or in the case of the container falling off a boat, your customer never got the product, so there's really nothing to invoice them. So it's really for when the shipment's made, product was received, and that your customer goes bankrupt or just is not paying you, and you can file the claim and be paid as long as it's a covered company on your policy.
And what if you got paid, then they went bankrupt, and then the trustee came and clawed back the payment?
You hope that your broker or your carrier put the coverage in place for that.
Okay.
There's a specific rider that does allow for those clawbacks to be protected.
Got it. And you mentioned hopefully you've covered that receivable. Is this all on a named customer basis, or can you have a blanket policy?
You can have a blanket policy, but you do have to have named coverage on the policy. Typically what you do is you name your top 10 to 20 customers, and then we figure out where to put a blanket coverage in place. And carriers all have different things that you can do. You can do with Allianz, you have easy cover. With Coface, you have blind cover. There are different names for it, but all of them kind of essentially get you to the same place where you don't have to name everybody.
Got it.
And when we talk about a named coverage, this is a perfect time to point out, you do not need to name and cover every single customer. A lot of people tell you that you have to. You do not. It's absolutely untrue. So if you're selling to Amazon, you don't want to cover Amazon, and why pay premium on sales that you don't want to cover? Same with a Walmart type. Now, I'm not saying don't cover them, because then if something happens, you're going to come at me all unhappy. But you could specifically exclude certain customers to save premium for sure.
For companies that sell B2G, can you cover sovereign receivables?
It depends. That really is a depends. It can be done. But it's country specific.
How about states and municipalities?
Yep, 100%.
Okay. Yep. All right. So what does it cost to do this?
If your sales are domestic, really, it's again like anything else in the world, it's volume. So if your sales are 100 million, your rate's going to be lower than if they're 10 million. But generally speaking, domestic sales, I would say a tenth of 1%.
As a premium?
Yeah, and we're up to 15. Depends because they all have minimum premium. So if you have 5 million in sales, your rate's going to be higher just to get you to that minimum premium. And then on foreign sales, as long as you're not selling to kind of funky countries, or into funky countries, I should say, you're looking at around 15/100 of 1%. So it's incredibly inexpensive for what you get, and the ability to upsell your customers, give larger credit terms. Essentially, I mean, you could pay for your policy in the first quarter of the year just on the increased sales you're going to do when you're willing to give somebody 100,000 in credit versus 25.
Yeah, we're going to dig into that part of it a lot. So one part of the cost is obviously the premium. What's the deductible?
Depends on if there's let's just call it a discretionary credit limit, because that's a name everybody that touches on it. If you don't have a discretionary credit limit, there usually 99.9% of the time is no deductible. There's always a 10% coinsurance.
Okay.
So if you have a claim of 100,000, you'll get paid 90. If there's a DCL, which that's short for the discretionary credit limit, your deductible is going to be in relation to what that number is set at. So it's really hard for me to give that. But let's say you have a DCL where everybody that isn't going to owe more than 30,000 is covered under the DCL. Mm-hmm. Typically, you can get a deductible of around 15,000.
Got it. You and I originally met talking about this in the context of international shipments. Obviously, letters of credit and bank guarantees are not completely bulletproof. They can be problematic, and there's a lot of other issues with them. How about if not just necessarily bankruptcy, but what if a buyer suddenly can't access the currency to pay you, or if there's such an enormous change in currency valuation that suddenly it's going to cost them 3 times what they expected to pay? Are those scenarios that this will cover?
In the case of the currency devaluation, in the event the government did this, that would be covered under what's called political risk.
Okay.
All policies generally come with a political risk rider, and they will tell you if certain countries are excluded because they're just obviously more volatile.
Sure.
But yeah, those type of things can be covered under the policies. Absolutely.
And do you see most companies using it just for the international receivables, or primarily for domestic, or a combination of both?
It's industry specific. A lot of people like it for the export, and I'm sure we're going to touch on the lending aspect of this, but the export aspect, because it makes your export receivables bankable. Mm-hmm. To a much larger extent, if they're doing it at all, you can go up to 85-90% on a inclusion rate versus 45 to 55% that most banks do on export receivables.
Yeah, so let's dig into that. I mean, if your commercial lending asset base is, if your receivables are a large part of that, then being able to maximize the value of that to borrow against is important. You just talked about the instance where your receivables are international, but I assume that applies if they're domestic as well.
It does, to a lesser degree, though. Okay. On the domestic side, most banks are giving 80 to 85%. So they'll go to 90 with the trade credit insurance policy. Mm-hmm. Depending on where your sales are, that 5% could be a large sum, or you could say that gives me an extra $5,000.
Right.
I'm not that concerned.
Right.
So it really all depends. It's a case by case on what the company's situation is. The export, we always know that they're lending less on.
And what's a typical rate that they would lend against uninsured foreign receivables?
About 45 to 55% typically.
So you can basically double the amount.
It's a push. I mean, you'd have to push them hard to get that in there. A lot of times they just say, we're not doing it.
Got it. So there's a lot of conflicting financial data right now. If we just think about, obviously global, there's uncertainty, but just the U.S. domestic market. On the one hand, car loan defaults are probably the highest they've been in a long time, if ever, or perhaps ever. But we see on the other hand, most restaurants seem to have lines out the door and the parking lots are full. Uh, what are you seeing? What's the state of the economy right now?
Well, I mean, it's again, it goes by industry. Retail is having a horrible time. Middle America doesn't have the cash to go out and buy what they consider to be non-essentials. Fuel prices are high. I mean, everybody says they're lower, but what's lower when we're used to $1.15?
Right.
You know, we're still up around the $3 mark. That's putting a pinch on a guy who hasn't gotten much of a raise in his factory out in Indiana in 5 years. So you know, they're putting gas in the truck to get to work. You know, if it's a choice between going to work or buying a new pair of jeans, they're skipping the jeans.
Right.
This is why you got retailers that are filing bankruptcy, going, liquidating even. I mean, look, Hudson Bay up in Canada. I know it's not the U.S., but that's Canada's largest department store, by far. And they're liquidating all but 6 stores.
Wow.
This week.
Wow.
So it's retail's in horrible shape. You go into restaurants, yeah, they're busy, but I think to an extent, Ed, I think we're kind of in a unique situation. I live outside of New York. You live outside of Boston. We are less affected than people in Wisconsin, Wyoming. We live in kind of a weird bubble where we don't really see what the day-to-day person's putting up with. And that's why, during this last election cycle, a lot of people lost sight of this. They were saying, well, look, the economy's roaring. Where do you live? Everybody I saw saying that lives in New York,
right,
or Boston. And I kept telling them that's not the case in mid-America. And they're the driver. They're 2/3 of this country.
So the business bankruptcy statistics, I don't remember exactly what I've read recently, but I think we've had more in Q1 25 than we had in all of 24. Does that sound like the numbers you're seeing?
It's definitely up. And I don't see it changing.
And you used to more frequently share on LinkedIn kind of rumors of potential bankruptcies or news of them. What significant bankruptcies have recently happened or are rumored to be coming soon?
I mean, I think it's hard to say that. That's probably why I kind of cut back on that. Okay. One, because I don't want to be always doom and gloom.
Right.
But look, there's a reality here. Saks and Hudson Bay split up, which that caused Hudson Bay to have to file. Saks joined forces with another retailer that's in horrible financial shape. So you basically took horrible and created horrible squared.
Wow.
So they're financially still in just as bad a shape as they were. They've told all their suppliers that anything that is old invoices, they're not going to pay until until I think I want to say November, and even then they're going to spread out the payments over 12 months.
Wow.
And anything new, no matter what your terms are, we're telling you your terms are 90 days.
Wow.
So this is a last ditch effort, in my opinion, to save the ship. And I don't see how that's going to work that well. One, and two, their exposure to it, going back to a trustee in a bankruptcy, their exposure to the trustee for HBC coming back and suing and saying you are directly the result of why HBC had to file. So you have financial culpability. That's a big risk. So I was, anybody selling to Saks, if you're not calling me for coverage, you're insane, because I think you're exposing yourself in a very large way.
So you raised a point earlier that often companies don't know who actually is backing the receivable, and there could be a parent company or somebody like that, couple levels away, that might just say, "Hey, we're tired of funding it. You guys are on your own." The other piece that this conversation is making me think about, though, is that often we don't know. I mean, we may or may not research the companies we're selling to, but we probably aren't digging into where their risks lay. We're just looking at the payment history, and we don't know who their major customers are or who their major customers' customers are. And so we may say, well, our people aren't selling to Saks. Well, if I have a client that does welding equipment and they're selling to a company that does all the in-store fixtures for Saks, it could well be that they've got a massive Saks exposure. So how can we possibly know, particularly in an environment of volatility and uncertainty, where those risks lay? Is it possible?
I think it is. A lot of companies don't want to do the hard work. They'd like to go, this is my customer, but this is your customer's customer. And you didn't see that because it goes so wide. It's incredible.
Right.
I'll use a great example. There was a company I used. I was talking to, this 2007, early 2007. And I said to the guy, they made something specifically to put on that was in construction. I don't want to single them out. It was in construction, and it was specifically, housing. And I said to the guy, are you concerned about this housing bubble that, in my opinion, is going to blow up here any day? And he goes, no. I said, why not? He says, well, I sell to supply houses. And they're my risk. And I said, well, but the supply houses sell to the contractors.
Right.
And if the contractors can't pay them, the supply house can't pay you. And he goes, that's not my problem. Supply house owes me the money.
Wow.
So for the record, I took my card back and I said, I think we're good here. And I just walked out.
Right.
Because he just clearly didn't get it. But that's what, you got to think of is your risk is not just the guy you're selling to. It's everybody that guy's selling to.
Right. And we work so hard to get orders.
To a guy that makes shirts and that guy's primary customer is Saks, then your risk is Saks.
Right. We work so hard to get orders. We're definitely going to come back to this topic about how this can give you flexibility to win orders. But first, you're obviously dealing with a lot of stressful situations. Probably not so much when you're writing the policy, but then you get this phone call from somebody like, "Uh-oh, it's happened. What's the situation?" How do you manage that stress?
I probably shouldn't admit the real way. No, it's, what, you try and understand the perspective of the person calling you. You got to kind of step away from it a little bit and understand that there's only so much you can do. Right. But you certainly try and help them navigate the waters as best as possible. Advise them in techniques that have oftentimes gotten payments made. If it's a bankruptcy, make sure they know the steps they have to do to be sure that they're fulfilling the requirements of the policy. So it's just making sure you help the client, because that's what my job is. My job is to help them get paid and sell more. That's really how I look at my job.
Do you ever have days where you say, screw it, you go home, hook up the trailer and disappear for a day?
Yes. Yes, there are. And while I'm hooking up the trailer, there might be a beer in my hand.
How big a trailer?
It's 38 feet.
And what's your favorite spot in? Do you restrict yourself to New England, or do you go all over the country?
With a kid in school and all those things, it's hard to go elsewhere. I think when he's out on his own, we'll probably broaden out a little bit. But we've gone upstate New York, Pennsylvania, but a lot in New England. Probably if you're looking inland, I think Pine Acres in Massachusetts is awesome. They're in the woods. They got this beautiful lake with a sandy beach, a pool, a hot tub, which is adults only, by the way, which is really awesome for the adults. It's a great spot. It's very quiet, very relaxing. And I won't tell you where to go in the summer for the beach, because that place will get too packed, and then
everyone's going to want to be there with Dan.
Exactly.
And you also, I think, to sometimes maybe give yourself a little bit of relief. You fire up the smoker and you make your own bacon.
I have to admit, yes, but I quit bacon. I don't eat it anymore, so I haven't made bacon in a while.
Really?
Yeah, I got rid of all processed foods. I guess I haven't told you about that, but yeah, I follow kind of a little bit of a clean diet these days.
Well, good for you. A lot more people are talking about that.
I'm not getting any younger.
That's true of all of us, I reckon.
Uh-huh.
All right, back to credit insurance. I think many of the capital equipment companies I work with, they just don't bother running credit reviews of buyers, but they think, okay, well, we've gotten paid these progress payments. In the end, normally the last piece may be what's actually their margin, 10 or 20% hanging out for payment 30 days after shipment. But would a policy like this cover progress payments? Like if they take an order, they've ordered the materials, they're beginning to build a machine, and the progress payments stop coming through, would it pay for work in progress?
It could. It could. You have to make sure that's on the policy. So again, it's the knowledge of your broker that's going to make sure that that's on there. Depending on whether or not first of all, progress payment coverage for work in progress, that typically involves having your customer file bankruptcy.
Okay.
To have the coverage.
Got it.
But it can be covered. Absolutely.
Okay.
Yeah. And of course, the product has to be unsellable. It has to be something where it's garbage. It's recycling.
It's so customized that you can't sell it anywhere else.
Yeah. And if you can't sell it, they're going to say sell it and then report what the difference was.
Right.
Let's put it that way.
Got it. So you contend that if a company does their due diligence correctly, they can really figure out where their customers' risk lays, and they can make a more informed decision. But if they don't go through all that work, and the customer's customer files, which leaves their customer in a very difficult way, the policy typically does cover that if they don't get paid, right?
Yeah. It covers slow pay. So if your customer comes to you and says, my largest concentration buyer is filed and they're out of business, and that puts me in a cash crunch, it would cover a slow pay.
But then you'd never be able to insure a receivable from that customer again, right?
Not necessarily. If the customer makes good on the outstanding amount, eventually coverage can't be gotten back.
Okay.
The carriers aren't unreasonable. They know things happen, so they often work with you. Like if you come up on a claim filing deadline and your customer says, I just don't have it, I can make payments. Wait, file the claim so you're still covered under the policy. If the guy defaults on the payment plan,
right?
But just tell the carrier you have a payment plan, as long as it's not unreasonable where he's going to spread out payments over the next 10 years. Typically, they're going to say, yeah, go ahead. And every month you got to report he made his payment. And as long as you follow that and they've agreed to the payment plan, they're not going to go after your customer. They may cancel or reduce coverage, but they're not going to go after
him. Okay. So you've alluded a couple of times to the fact that this can offer a real competitive advantage. If we're heading into a recession, there could be some companies that are struggling. There could be all this additional uncertainty. There could be implications of tariffs. If a prospect has been shut off by the current vendor, that may make people hesitant to sell them. But it feels like this may give you the opportunity to take orders that others are afraid to. It may give you the opportunity to extend a greater credit limit than you would otherwise. Talk about those advantages that having this can give you from a sales perspective to get new business.
Yeah, it gives you the flexibility to offer terms where you otherwise might not want to. A lot of savvy companies have a credit management department, and they're going to review things, and they're going to come back and say, I don't want to give them more than 50,000, and they want to order 150,000. Well, if you can get a credit insured for 150, well, now you're selling it and you're covered. Give them the 150,000 and make the sale.
Right.
That extra 100,000 one sale could pay for your policy for the year.
Right.
You assume your margins, 15, 20%, and your policy costs 10%.
Mm-hmm.
It's paid for. And if you're giving them terms that other people their credit department saying the same thing, 50,000, 75,000, but you're willing to go, I'll give you 150. Boom. Who do you think is going to get the order?
But if they're that problematic, is it possible to get that risk for that customer underwritten?
I have an interesting scenario I'm going through right now where every carrier said no to a client of mine on coverage, including their existing policy with another carrier. So I went to another carrier and I ran an application and they said, yeah, we can give them XYZ, X amount of coverage on this company. And for these people, this is a game changing sale. This is going to take their company and like really take it to the next level. So they really want to do it.
Right.
And they weren't going to do it without the coverage. So I found them the coverage and they're going to get it done. So yeah, it's, a lot of it is you got to shop it. You got to know how to pitch it too. I mean, I had a great example of a company that had two really horrible customers. Everybody knew they were going to file eventually, but wet. But he also had 6 really rock solid ones. Well, we insured the 6 rock solid ones to get him the coverage on the 2 absolute garbage ones. It was like insuring Walmart and Amazon and pick some other huge company that's never going to, well, not never, but most likely will never file bankruptcy.
Right.
And paying premium on it. You don't want to, but if I can get coverage on these 2 and do these sales, it makes it worth every penny. That's what we did.
Interesting. So risk mitigation, creating additional opportunity with sales flexibility, but you also make the point that it can help companies free up cash and reduce financing costs. Dig into those a little bit.
Well, when you're dealing with a bank, obviously, if you're taking the risk out of their hands by insuring the receivable, you can negotiate a better rate with the bank on your lending facility.
Okay.
And as far as freeing up cash, you don't have to put money aside for a loss reserve. So now that cash is free to do with what you want. And again, the easy part about freeing up cash when you're using your export receivables that otherwise were excluded, well, that could open up a gigantic pool of money.
Sure.
That a lot of companies, their growth is stymied by the fact that they don't have cash. And if you've got a giant pool that's just sitting there that can't be used, free it up, use it, take your company to the next level. Let's go.
How often do you find companies that just really are naive about all this? Do most companies know about it, or is there a lot of folks out there that don't?
Changing, but I would still say in the U.S. it's not in its infancy anymore, but it's a little bit slightly older than a toddler. Putting it in those terms.
So most of your conversations when you're prospecting, are you trying to help people understand why they should think about this insurance, or are you helping people understand why your insurance and your ability to help get them coverage is distinct from some of your competitors?
I'm more, oftentimes now they know of it enough to make themselves dangerous.
All right.
So my job is to kind of do what I'm doing here, is to make sure they understand all the ins and outs. I have to understand their business. Selling what makes me different than my competitor. Look, it comes down to 1, personality. 2, do you feel comfortable that I know what I'm talking about? 1, I know what I'm talking about.
Right.
I'm dealing with a company now that they had a policy direct with a carrier, and I think I mentioned this dating situation where you're selling in January, collecting in December. They had a situation where they had a claim, and they said, "Well, you're not covered because you're outside of the terms." And this is what the direct carrier didn't even know what they should do.
Wow.
And I was like, "Look, this is what you need to do." And I even went to the agent over there, and I said, "This is what needs to be on their policy." And I gave him his company's rider. I said, "This is the rider you need." I talked to him an hour earlier. He said he'd never heard of what I was talking about. So that's why I sent it to him.
Wow.
And of course he says, well, if the client's on the email, he says, "Oh, I knew that." In my head, I'm going, you know it because I told you an hour ago.
Right.
So, that's you need to know. You need to know your stuff. So I think it's when people understand that I know what I'm talking about, they feel comfortable, and that kind of separates me from the others.
So if somebody is intrigued by this, how do they get in touch with you?
You can reach out to me on my email, which is the dan@tradesmartins.com. You can call my cell, 203-559-9283. Those are probably the two best ways.
LinkedIn?
LinkedIn, yep. It's under Dan Schobel.
I'll drop that link in the show notes. I know you're brand new with your company. When are you going to have a website up?
That's my plan for the weekend.
Got it.
It's been, as we mentioned earlier, the tech issues have been quite fun to jump through. And every day I go, I'm going to get to the website, and then something else happens, and I go, now I got to deal with this. So,
right. What would you say are common misconceptions about trade credit insurance?
Expensive. It's not. I mean, a tenth of 1% to protect your receivable, which is what pays your bills for virtually everything else. When your company's margins are, the average margin for companies out there is between 17 and 20%. If a tenth of 1% is too much, I think that's crazy, because without your receivables getting paid, your lights don't get paid.
But there's obviously a fair amount of overhead to properly research and purchase and manage the policy. Is that true?
That's my job.
Okay.
Yeah, that's 100% my job. They don't pay me. I get paid by the carrier.
Right.
So my job is to go out there, shop everything, come back with the best and brightest of the quotes, kick the carriers in the teeth on the premium, which I got to pat myself up on the back here a little bit. The average, when I bring in a new client that's either been going direct or with another broker, on average, I save them 25 to 30% over what they were paying prior to coming on board with me.
With the same rating carrier and the same coverage?
100%. Look, there's a ton of carriers out there now. Most of them are very specialized. They only want certain industries, and even in those certain industries, they only want certain segments of that industry.
Okay.
To this day, there's still the big three: your Coface, Atradius, and Allianz, and not in that order. Allianz is by far the largest one. So those are the ones that you're 90% of the time going to end up with. Because they're just the big players, and their policies have become more flexible over the years to compete with the people that are coming into the market. So it's kind of, the market's changed. It's become way more creative. A lot more can get done than it used to be able to get done. Premiums. A lot of people say, "Oh, I quoted one of these things out in 2005, and it was incredibly expensive." They were. But that pricing is no longer. That is long gone.
But it also feels like there's so many intricacies to this that you can't just buy the policy and slap a rider on. You have to be very specifically accounting for the very likely situations that you're going to encounter.
That's, again, really partly my job, is to understand your business. There are certain policies that I would not recommend because it involves a more savvy receivables department. And if you're a 3-person shop and you're getting this because you want to free up money so you can grow, or your bank says get this and we'll give you more, and you need it, then I'm not going to recommend that you have a policy where you got to manage that receivable every day,
right?
Because you just don't have the time,
right,
and the resources. So, and then there are some people that have the resources, but I don't think the resources are really up to snuff,
right?
And again, I wouldn't recommend it because I'm not going to tell them that, because that's a touchy subject, but that's part of my job, is also understand exactly who's doing what and what they can really handle that.
Sure.
So that's why I'm a broker, but I'm also an advisor and a sounding board.
Right.
Because there's a lot of times I go into people and I talk to them about the trade credit insurance, but then I see something else and I go, "Hey, have you ever taken a look at doing this way? Or have you talked to your banker about this?" And I introduce things that they hadn't thought about, and sometimes they go, "That's a great idea. I never thought of that."
Well, that's certainly the way you're differentiating yourself. I mean, everyone has carriers. Everyone can spit out quotes for policies, but you're differentiating yourself based on your ability to help them understand the business opportunities they have.
Yeah, and I look at, I'm not just a broker on trade credit insurance. I'm part of your team, because your success is my success. And if I do right by you, you're going to tell people I did right by you. Well, at least I hope you would. But that's my role. My role is to really make you feel comfortable that I've got your best interest at heart, and that's it, purely.
And I would say the biggest premise of this conversation, going back to the Industrial Growth Institute podcast, we want to help companies grow. This idea that you can take orders that you might otherwise hesitate to take if you've got this coverage. You can win orders from competitors they might be hesitant to take. I think your approach and your understanding, your ability to help a business owner visualize those situations is huge.
That's what I try and do.
All right. So wrap us up then. Make the case for why industrial manufacturers, whether they're consumables or professional service providers to industry or capital equipment companies, why should they be spending some money on this? And how does it help them create opportunity and flexibility?
In short, you're going to make more money than what you're going to spend. And you're going to sleep well at night because you know you don't have to worry about your receivable being paid. And if something does go wrong and it's covered under the policy, you're going to get paid. And that's ultimately, the most important thing. And if you have a concentration, you're crazy if you don't cover it. If you've got a guy that's 70% of your business, if that guy goes south or just says, I found another supplier and you're out, come chase me, you're in big trouble.
Right.
So, it's just a simple matter of sleep well, get paid, grow your business, make more money, sell it.
Well, good stuff. And congratulations on launching your company.
Thank you so much. Thank you very much.
Everyone, thanks for listening and watching. If this episode prompts some ideas for you on how to mitigate risk or unlock new opportunities, then please give it a like, share it, drop a comment in for Dan and I to read and respond to, share it with a colleague. And of course, also please subscribe to the Industrial Growth Institute podcast. Every week, my guests put out interesting revenue growth related ideas for you to digest and find, whether they're applicable for you. And so by subscribing, you'll make sure that you don't miss an episode. Thank you, Dan. Thanks for joining me.
Appreciate it, Ed. Had a great time.
And thanks everyone for listening and watching.